Today, we're going to be discussing what mechanical trading is and why you're losing money because of it every single day. So let's begin. Hello guys, welcome to this video. You're in the right place if you want to learn where to invest and how you can invest and save. Specifically, if you're a teenager, your school doesn't teach that kind of stuff, you don't know where to start, etc, etc. Now, as usual, make sure to go down in the comment section below and type up any question that you might have about financial literacy or investing or anything that I might have said in this video or other videos, because then we can have more video ideas about what kind of content would you guys want to watch. And we're all here just to help you guys out, so that would really help us here make content that you would want to watch, and that's all this channel is really about. And yes, I still am doing this book stack thing. Now also go down in the description, you'll see a video link. I did a interview with the Teen Financial Advice channel. We talked about how, beginners can start investing, my route, etc, that kind of thing, so make sure to check it out after this video. Now in today's video, we're going to be talking about mechanical trading, or also known as algorithmic trading, automated trading, and why you're losing money because of it. And we're going to start off by defining what it actually is. What really mechanical trading is that it's also known as algorithmic trading because it uses algorithm, it uses software in order to create these trades at a much faster pace than a regular human trader on Wall Street could do. Like we have a mental capacity on how fast we can trade and how fast we can click buttons. With computers, they can do it at a much faster pace, and they are able to buy a lot more shares all at once than we manually could do. And that's really why, that's the lure of using algorithmic or mechanical or automated trading. That's really why somebody would choose to use it in the first place. It's a lot faster, and there's also no emotion in it because you're not thinking, there's no conscious biases there, that kind of thing. However, it does use a lot of historical data. Algorithmic traders will like to test their algorithms on the past, and as usual, past results do not ensure future results. If somebody got a bunch of C minuses in the future on their math test, that does not mean that they're going to get another C in the future. I know, trust me on this one. And so yeah, again, just remember, keep this in mind, that it does use historical data when creating algorithms. To give you a clear picture of what algorithmic trading is or what mechanical trading is, here's an example. It can be literally as simple as this. Take the current price, stock price, divided by the stock price 9 weeks ago, and if it's greater than X, then buy or sell 1,000 shares. That's really what it is. It's just simple coding on Python or other computer languages in order for you to automate those trades at a much faster pace than a regular human could. Now we will talk about why you're actually losing money with it when you're a regular investor at home, or even an investor or a trader on Wall Street, like a human trader. So here's why mechanical or algorithmic trading is actually costing you money. Now, to understand this, we have to look at the word volume. Volume really is at the core of this problem. Volume, I've talked about in earlier videos. It's simply how many times has a commodity changed hands? How many times has Apple stock been bought or sold in the day? How many times has it gone from me to another person, to another trader, to another investor? Now, think about it like this. When you're algorithmically trading, what's happening is that you're buying a huge amount of shares, or you're selling a huge amount of shares at a much quicker pace than a human would, right? Because you're using computers. You're able to buy so many more shares at a much quicker pace, and because of that, there's going to be more volatility. Now, for an example of this, just take an example of the flash crash of 2010. Basically, what happened was that there was a huge sell-off order.
Let's take a look at P&G. All right, this is going to say everything. P&G is now down 25%.
Oh, well, that's true. If that stock is there, you just go and buy it. It can't be there. That is not a real price.
That stock was down 2%.
Well, just go buy Procter.
All right, this is an unprecedented
Just go buy Procter & Gamble. They reported a decent quarter.
Is there a hedge fund that is liquidating? Is there a distressed seller?
Anything else that's happened?
At 49.
Now, this was due to algorithmic trading because they sold a lot of shares all at once. And because of that, the Dow Jones dropped almost 10% in, get this, 20 minutes. In 20 minutes, the Dow Jones was only 90% of its original value. And that's just one example. Really, what's happening now, we can see, is that in the beginning, it used to be a slower curve than today. Today's markets are more like this. It just ziggles up and down, up and down. However, in the past, I'm saying that over the long term, over a span of years, it looked like this. Today's markets, you can clearly see it may drop, then it may go up, then it may drop in that year time frame. I'm not talking about a day time frame. I'm talking about months or years. We can clearly see it's a lot more volatile than it was in the past. And I do believe algorithmic trading has a huge thing to deal with that. Now, as usual, don't make sure to comment down anything below about what you guys want to see in future videos. Check out that Teen Financial Advice channel, really great info if you want to start getting invested, you know you want to. And yeah, that's really, thank you guys once again for watching, and I'll see you in the next video. Oh shoot, I forgot to say that you need to subscribe and comment. Oh shoot. Oh, okay, yeah, well, please do that if any of you guys are even watching it at this stage. Thank you.